Hey, how's it going, Sean?
I'm well, Brian. How are you?
I'm good. I'm good. Thanks for taking the time out of your day
Of
to,
course.
kind of chat with me about, different market insights from your perspective, on this sort of chat, right? And that's what it's just gonna be a chat. Is basically focused on, learn a little more about yourself, your background. And then also share some insight that you are currently seeing in your own industry to kind of highlight some trends and some opportunities that may be there for folks that are trying to get into commercial real estate or invest themselves,
Sure.
or they might have essentially issues of their own that they need a professional like yourself. Thanks
Sure.
for this today. And for everyone listening today, today on the call, we have Shaan Dadlani. He's an investment sales broker with Northmark, specializing in net lease retail and 1031 exchanges. Now, a little bit about you. You're from Miami,
Born
one of
and raised.
my favorite cities. Just, I love Miami. So,
Me and you both.
yeah, you want to like sprinkle in some joys and things you love to do when you go back home, please do. You went to University of Florida, and but you're
Yes,
currently in
indeed.
New York. So
Yes.
yeah, share a little bit more about yourself that I haven't kind of laid out a little bit.
Yeah, no, I appreciate the introduction there, Brian. My background's actually engineering and operations. That's what I went to school for. So finding, optimizations, efficiencies in systems, that's a passion of mine, and kind of applying that to retail real estate assets is really what I try to focus on and achieve, help my clients achieve. So if anybody listening does have retail assets that they're either looking to sell, looking to acquire potentially, repurpose, reposition. That's the type of stuff we do. A lot of corporate type leases, big QSRs, banks, quick service restaurants, QSRs,
Okay.
fast food chains, retailers, big box, medium box, your Walmarts, Dick's Sporting Goods of the world. So just acquired Foot Locker this morning, if you saw that in the
Cool.
news.
Nice.
Yeah, those types of things impact our world quite a bit. So I actually started my real estate career though in Charlotte, North Carolina, a market I'm still very near and dear to. A lot of my clients are still based there, seeing a lot of growth. We're seeing a lot of capital actually flow from New York into the Southeast. That's been, I would say, pre-COVID, but especially in COVID, a lot of those states are kind of more business friendly. And so you have a lot of capital moving from New York, New Jersey, California into Texas, Florida, North Carolina, South Carolina. And so being from that region, I'm really able to help a lot of the investors and clients I work with that are based here in New York, identify those areas of opportunity, those spaces, places they want to be
Yeah.
in the cities that I've had the fortune of actually living in myself.
Wow, nice. So it's I appreciate you sharing that background, also sharing the shifts of where the money's going, right?
Yeah.
And just kind of curious, being in New York and being with Northmark, like from your perspective, on the ground in New York City, what makes commercial real estate an attractive alternative investment right now? I mean, especially, given what's going on in the market, compared to the traditional assets like stocks and bonds.
Yeah. Yeah. It's a great question. I think it comes down to operational control that you can do more and you can react and you can pivot a little bit easier than with a stock or a bond where you don't have control. Yeah, you're in a shareholder meeting with a stock, but you're not on the board, you're not in the C-suite unless maybe some of the people are listening to this. But in terms of making strategic decisions like maybe acquiring a competitor like Foot Locker, you're not included. You might be a stockholder of Dick's Sporting Goods, but I'll use them as an example. It's a good one.
Yeah.
You might be a stockholder. You might disagree with the idea of acquiring Foot Locker for 2.4 billion. But you don't have a choice. That's not up to you. That's your stock. And so the impact of your stock, you probably weren't even privy to that. That's the stuff that happens behind the scenes.
Mhm.
Versus if you are a landlord of a Dick's location, a retail Dick's location, while yes, you are tied to Dick's for that lease, but that lease will end eventually, and you still have the intrinsic value of the land that you are able to utilize. And so that is what we, as as much as I work in investment sales, at the end of the day, I'm a real estate guy.
Right.
And one of my favorite things about real estate is they're not making any more of it. Land is land. It's there, right? Yes, you can build and construct, but you can change, you can adapt. And I think that's something that's really appealing to a lot of people about real estate is that control, that ability to change and adjust. We often talk about what is the highest and best use. And that changes over time. And so the ability to adjust and change is, I think, really important in a world where there is a lot of uncertainty right now. I think you and I would agree.
Yeah.
And that's been something we'll get into a little bit later that's been impacting our market quite a bit. It's just the uncertainty. I cannot forecast, and a lot of our clients, they're on 5 year, 6 year, 10 year holding periods. And so when you're looking to acquire an asset and you're doing your underwriting,
Right.
the farther out you go, the harder it gets. And so that's really impacting us right now is kind of that uncertainty in the market. But for a lot of people, that's where the opportunity is, right? That's where they can say, okay, well, if it goes this way, we can do this. But if it goes this way, we can do this.
Right.
And that's something that real estate allows you to do.
Yeah, and I agree with that because I'm a big believer on the diversification of our assets and putting my old financial planning hat on, if I put like you mentioned Dick's, right? If I put all my money into that one company, whatever happens, I'm like praying to the
Yeah.
land of like please give me
Yeah.
the good fortune of good things happening. But it's life.
Yeah.
Things happen and things change. And so better to like sprinkle your money and your assets across to
Exactly.
weather any storms. So you talk about the uncertainty, right? And there's a lot, right?
Yeah.
Things change every 30 minutes, it seems sometimes. But is there a diamond in a rough? Is there a certain strategy? Is there a sector or a class within financial real estate, such as multifamily, industrial, retail, or office that one could say, I want to put my money there. Like
Yeah.
out of those, which are showing the most resilience or upside in today's market?
Yeah. So of your call it your four major food groups is like what we like to call them multifamily, retail, industrial, and office. I would say your biggest kind of upside and darlings right now are industrials number one. Still a lot of demand. Now tariffs have changed that a little bit. But you would include data centers in that industrial space, and those have been very, very hot right now. You can't go 2 minutes without someone mentioning artificial intelligence, and the data centers are a big part of that, and a lot of those are net leased assets. I would say retail, though, while it was interesting during COVID, everyone thought it was going to be the death of retail, and then you add in the kind of headwinds that retail was facing with online, and consistently we're seeing no, people want to go into stores, they want to go into restaurants and coffee shops, and they want to see and they want to feel. And even for a lot of the ones, retailers have done studies that there's a synergy between having a brick and mortar and your online, where you might not have all of your inventory in store, but being able to see some of it in person and then order the size you want online is actually really beneficial. So I'd say we're seeing a lot of resilience in industrial and retail right now specifically. I'm going to make a shameless plug for retail. That's my specialty.
Yeah.
But we're seeing, and while there are headwinds as well, and we'll get into that a little bit, you are seeing, a lot of retailers file for bankruptcy, shutting stores, but actually leasing activity and acquisition of those types of stores has been very strong, very powerful. Like for the ones that are growing, looking to add to their footprint. We've seen a lot of those leases, get picked up by the other retailers Burlington Coat Factory is an example. Five Below is an example. A lot of these kind of big box stores, you know, shuttering, they're immediately being backfilled. I speak to, I'm not a leasing broker, but I work with and have a good number of friends that are, and they've been busy. They have said that their leasing activity has been some of the strongest they've seen since COVID.
Oh wow, it's amazing.
Yeah.
I started when you
Yeah.
said something about there are people that want to see things online but actually touch and feel it and
Yeah.
try it on. That is 100% me. And
Same.
my wife just laughs at me all the time because she's like a big like, I can just get online. If it comes
Yeah.
back doesn't fit, I'll return it. I don't want to do that. I don't want that process. So
Yeah. I don't either. So wasteful. Shipping and oh gosh, no, not for
come on.
me.
Yeah, same. Just timely. It's just like I don't know.
Yeah.
But it's interesting you mentioned that. Like retail is coming back. Oh, that's really good.
Yeah, I would say in person and retail, when we think of retail, don't just think of it as like buy a new pair of shoes, right? I include your coffee shops in that,
Yeah.
your restaurants, your chains, things like that. Experiential, right? Gyms are retail gym locations. Those types of things are all kind of included in retail.
Okay. Okay. So with that, we talked about the upside because, retail's going up. I would want to probably invest my money in that. But I'm going to disclaimer. I'm not saying any giving you financial advice, but I'm just
No, none of
saying.
it. Yeah.
For anyone listening, still, if you have an advisor, speak to them. But for the professional on
Always.
Sean, who understands the investment market and commercial real estate, I would say definitely connect with him. Um, so you meant we talked about the commercial real estate that has potential upside, but like everything, it has risks, right? What
Of
are some
course.
of the, I mean, you mentioned headwinds before. What are some of the current headwinds that we're seeing? And then what are some potential challenges that investors should probably be aware of in the market?
Yeah, I would say that uncertainty is tough and it is we don't know exactly what's going to happen, specifically with tariffs. That's the kind of elephant in the room right now that'll have impact on a lot of retailers. We deal with a lot of home improvement stores, Home Depot, Lowe's, Tractor Supply, Harbor Freight Tools, Sherwin-Williams, right? Those are a lot of our types of investment assets that our clients either own or are buying. And it's difficult when a lot of their product is coming. And so we don't know, while right now retail feels good and strong, but if prices start skyrocketing and your whole Five Below is an example, right? These kind of discount retailers, dollar stores, how can I sell you something for $1 if it doesn't cost me $1, right? Or
Exactly.
cost me less than $1? And so I would say that uncertainty is the main kind of where we don't know exactly what's going to happen. When we can plan, at least we can plan, right? And
Yeah.
forecast. But when things are changing so quickly as they are right now on a dime, um, that can really have a myriad of impacts. And I would say that technology kind of development is also one. I'll give an example here where in the retail investment space,
Mhm.
um, pre-COVID going into COVID, Walgreens was a very hot kind of net lease asset, um, trading at compressed cap rates, very difficult to buy one. They were seen as kind of this darling of the net lease investment retail world. Pharmacies, people always need their, pharmaceuticals. They get the added bonus of being able to sell you toilet paper and a Coke and a Mother's Day card. You didn't get your Mother's Day cards. You're a little late, but go ahead and get them. They're on sale now.
For next year,
Right?
right?
You get those added benefits, right? And slowly, you know, those there have been disruptors in that space, online pharmacies, Amazon direct to consumer, changes in the Medicare and healthcare systems that are impacting billing and how these companies get paid. And then you add on again things like Amazon, other kind of stores providing kind of the toilet paper, the Coca-Cola, whatever it is, and it's really impacted their model. And so they're really adjusting and changing right now, kind of based off of all of these macroeconomic factors. And so we went from a space where they were trading at these very compressed, kind of high numbers, compressed cap rates. Sorry, I'm using terms, but high, let's just call it high value numbers. And now, because of all of the headwinds that the company as a whole is facing, um, it's very difficult. Now you have the benefit of being on good corners, but Walgreens are constructed in very certain ways. They're not as fungible as some, and we'll get into kind of what strategies we're seeing. But those are ones that almost have to be completely leveled and repurposed in a lot of situations. And so that's led a lot of investors in really difficult in difficult situations where they have this retail box, they have a lease in place, but they're not really sure what's going on with the company. Walgreens is actually being acquired by Sycamore Capital. That deal was announced a month or two ago, should be closing at the end of the year. They're a private equity firm, and that just leads to uncertainty. What is Sycamore going to be doing with them? Are they going to be shuttering a bunch of stores? Are they going to try and pour a bunch of capital and reinvigorate? So I think going back to the question, though, Brian, I think there is a good bit of uncertainty and a lot of change, AI being one of them as well, and how it's going to impact retailers and commercial real estate is a concern or a watching point for a lot of our investors right now.
Yeah, I mean, uh, I got a professor that once said, as the environment changes, so too must the company. So to that point,
Mm-hmm.
it's
It's a
like,
great point.
going to happen. The environment has changed with AI and the current market and, seeing how these
Yeah.
companies pivot to certain things, is important. But also, if I'm investing my money, kind of just like, hey, Sean, like, where's the pivot, right? Like, give me some
Yeah.
advice. Uh, so
Yeah, you should have and that's where real estate is powerful because if you buy good real estate, you can have a good contingency plan.
yeah,
And so for the Walgreens examples, some of those people are going to be in really tough situations. Some of them are going to be fine because they just have a really good corner. They were paying a reasonable replaceable rent. And okay, Walgreens leaves, no worries. I'll find a gas station to fill in or a daycare center or a dog groomer or somebody to take over that, call it 13 to 15,000 square foot box on a good corner with a signal. So we again just focus on the real estate. What's the dirt? What's the value of the dirt and the intrinsic value there? You want to couple it with the lease and who's actually renting it up front. But we've very high attention and focus and level of detail to the worst case scenario is what if your tenant leaves, right? What do you do then?
right. Okay, I love that. So then, what are some strategies? Well, what are some creative strategies, right? Because in your line of business, I feel like you're always creating opportunities. So you have to create opportunities for those that want to offload their portfolios or those who are trying to get into a portfolio, and give them strategies to this. So what are some creative strategies or structures that your team is using to uncover or unlock value in today's commercial real estate environment?
Yeah, it's interesting because it's not that creative. It's a lot of returning in this type of environment. It's returning to those fundamentals we were talking about just now
Okay.
of where, where is your asset? Is it accessible? Is it in a place people actually go to? And what is the rent? What is your current tenant paying? What's a future tenant going to potentially pay? And so we're seeing a lot more because of the cost of capital where it is, a lot of people kind of shifting to what we call value add, and not just buying something with a long-term lease in place that can give you a 6-7% return rate, but
Mhm.
instead um, buying something at maybe a lower return rate with the intention of getting somebody else in there at a better rent or a better grade tenant, an investment grade tenant versus maybe a mom and pop. And I think a lot of that value add, it goes back to the fundamentals of what is it being leased for? Is this a space people actually want to be in? And focusing on, finding below market rents. You would think it's kind of counterintuitive that you would want actually somebody, when you're purchasing an asset, you don't want someone paying top dollar. You want someone paying below market, because it gives you upside to go achieve, and it insulates you from any potential risk. That because if you have somebody, and this is another example kind of with Walgreens and where we're running into issues with Walgreens, is they were paying above market rent in a lot of situations. And that's good as long as your tenant's in place and you have them. But once that tenant leaves, let's say you're forecasting $50 a square foot for your rents, and that's double the market, right? And you paid however much for an asset and your return was a 7% return. But now Walgreens is maybe vacating that space, or whoever your tenant is can't support that high rent. They are no longer going to be able to pay you $50 a square foot. And you're looking out in the market and it's $30 a square foot. And so now what your return rate was at 7, 8% is cut in half, just like that overnight. And so we're really, really focused. I think a lot of investors right now are focused on that, those fundamentals of what is the rental rate, and finding things that are below market. And again, not, you would think I would want to, yeah, give me as much as I can. And no, that actually presents a lot of risk for you down the line. And so focusing on kind of lower rents that you can easily replace, and focusing on good fundamentals, good corners, good dirt that people can easily access and want to access.
All right. As you're speaking, one of the things that goes to my mind, because because I'm in real estate, as we both know, and we talk about real estate all the time, and on the residential side. But when talking about syndications, right? And we talk a lot about there's a lot, plethora of people that want to invest in real estate that um but don't have the information or don't have the expertise. Some things don't have the time, right?
Yeah.
And most of the time, usually most people don't have the large amounts of money that is perceived that you have to get in these investments. All of that to say, do you see, there's an influx of folks that have syndicated and pooled their money together? For those I'm talking about syndication. It's basically you're pooling your resources, pooling your money to then go into an investment. Is that happening, more often than not in commercial real estate space?
Yes, it definitely is. You have syndicators on the net lease side as well. And that's actually a strategy that is, very popular right now because the cost of capital is so high, right? Your interest rates, debt, just right. So versus in a more normal environment, I might be able to take an 80% loan against an asset and it be okay because my return rate on the asset is 6% and my loan is 5%. And so I'm making a percentage point on everything I borrow, and that's how we make money, right? Right
Yeah.
now, it's flipped and you're getting a lot of negative leverage situations. And so if you put too much debt, your cash flows get absolutely crushed. And it's the inverse where I'm buying an asset, let's call it at a 6% return rate. But the cost of my debt is 7%. And so it does make sense to go out and say, let me go get some equity partners, syndicate some money together to say, are you good with the 6% return rate? Now my whole pie, my slice of the pie is less, but my percentage is for what I'm putting in is better than versus taking out that debt. So it is something we're seeing quite a bit, given the high interest rate environment, and finding different kind of, I think a lot of individuals are trying for kind of shorter term loans, expecting that in 2, 3 years, the market will change. That's something that's very risky. I think a lot of people got into trouble, in the multifamily space when they took shorter term loans when interest rates were low, thinking rates were going to stay low, and then rates skyrocketed. And now you have an asset that can't support, right? Your rents can't support this higher interest rate and this higher mortgage payment. So there's risk there, but it just depends on your opinion. And this is where talk to your financial planner, talk to your CPA, and partner with the right people. I think going into strategies and how to invest, it's so important to, not go it alone, because you don't know what you don't know. And
Right.
so working with people that have experience, that have done it before, that have seen multiple market cycles, ups and downs, that know how to insulate from risk, I think is imperative in this type of market.
Awesome. So now taking that, if I'm new or someone is new to the commercial real estate investing, like I have
Sure.
the some capital, I'm really want to put my money in a different place outside the market or whatnot. Um, Especially, in a complex market like New York City, right? What is one piece of advice that you'd give them before making their first deal?
You should turn down 10x the amount of deals before you actually decide to do one is kind of the way I think about things. The best investors that I know say no way more times than they say yes. They will look at hundreds of deals before they find one, and stick to your guns in terms of when you define, and hopefully you have an investment criteria, you have margins you want to hit, you have rules, right? Rules of engagement, your investment. And right, that's where these institutions, REITs, private companies, family office, they have investment committees. And the job of those investment committees is to make sure that you're playing within your boundaries, right? And yeah, you can maybe, if you have experience, go outside them a little bit. But I would say for new investors, it's really important to define what is your boundaries, what are you going after, and stick to that and be very, very disciplined. And again, you should be turning down a lot more deals. If you're pulling stuff and you're like, wow, there is 50 things I want to invest in, we could do any of these 50. Wrong. I'm going to tell you you're wrong. There should not be 50. If you have a really defined criteria, there should maybe be one or two.
Yeah, I
Like
agree.
it should be that strict.
Like you have too many options. You'll get now was it paralysis by analysis or something, whatever that term
Well,
is.
not even, yeah, analysis paralysis, but also really pick apart the deal, right? Like there are, and if you don't know how to pick apart the deal, there's another flag. You should know how to pick apart a deal and find those red flags and really look for all of the downsides. I think that's the other thing that separates really good investors is they see upside, yes, but they are really focused on where the downsides are and where can we lose money because it's a lot easier to lose money than make money. And um, that is again like where I think a lot of new people they get really excited. They're like, oh, we could do this one. That person's dumb. No one's bought this one. This one's been on the market for a while. There's a reason it's been on the market for a while. A lot of people have looked at it. There's a lot of people smarter than you, than me, that have looked at it and turned it down. And well, why did they turn it down? And understanding that. Um, so yeah, someone new, stick to have an investment criteria, define your parameters. And it's going to be hard. It's not easy to stick to those things. You're going to want to move out of that. But the second you kind of move out of those boundaries, that risk profile increases significantly. And therefore, your likelihood of losing money and failure increases significantly. And especially when you're getting started, that could be the start and end of everything. So you should be rejecting and turning down a lot more deals than you're kind of jumping into, especially when you're starting.
I love that perspective a lot because I have a couple friends and some clients when 2008, 2009 happened, they just went kind of gangbusters and started buying up multifamily houses in areas that you really would not even buy even till today, right? And they're kind of feeling it now because no one wants those assets because
No
their
one's assets.
area have not changed. So yeah, I like that perspective. Really, uh, turn down the deals and study the deal that you feel is right for you and just kind of go
Yeah,
for it.
stick to your discipline. Be disciplined. Like I think that is imperative when it comes to investing in real estate.
Love that. Well, we have about another 4 or 5 minutes left. And I want to, give you an opportunity. Like, what? So, how can people find you? and
Yeah.
connect with you. And who are those people that you want to connect with as well?
Yeah, I appreciate that, Brian. You can find me on LinkedIn. I don't know if I'll provide my email. You can go to northmark.com, find me on our website as well. The list of brokers is there. I'm based out of our NYC office. The people I want to connect with are investors, landlords, asset managers, financial planners. Maybe you have a client. A lot of our clientele base is 1031s. We mentioned that at the top. We specialize in 1031s. If people listening to this aren't aware, a 1031 is a tax tool. It's a tax deferred exchange where when you sell one investment asset, real estate asset, you are allowed to purchase another one without paying the taxes, the capital gains taxes on it. So I buy an asset for 5 million. I later sell it for 6 million. If you were to just cash out that 6 million, the government's going to say, hey, you made $1 million, pay us a very high, nice capital gains tax on that $1 million. Or you can utilize a 1031 exchange and invest that full 6 million into another property. And net lease, the beauty of net lease, why we like it so much, it's minimal management. A net lease asset is a specific type of lease where the tenant is responsible for insurance, taxes, and maintenance of the building. So it's very hands off, which a lot of investors really like, especially coming out of multifamily, where you have to be very hands on. You have a lot more turnover, right?
Yeah.
Lease renewals come every year. A toilet breaks, it's on the landlord to fix versus a 10-year Starbucks deal, a 10-year Dick's Sporting Goods deal. They will handle the building, they'll pay the taxes, they will even pay for the insurance on the building. You just sit back and be a landlord. And so people going through or thinking about a 1031 exchange, financial planners that have clients who are considering net lease assets, retailers as well who are looking to acquire spaces, growing retailers, operators of retail assets. Those are the people that we work with and want to continue to work with. So if anybody listening is either an investor, a landlord, an operator, a financial planner, or looking to do a 1031 exchange, I would love to connect. Again, you can find me on LinkedIn or on our Northmark website. I'm out of our New York City office.
And everybody listening, this man is smart, intelligent. We had great
Too kind.
conversation. I remember the first time we met, um, uh, the conversation was great. And I said, okay, I need to figure out a time and how we can kind of get this knowledge out of your brain and let the world know just what you do and knowledge you have. So, for everyone that's listening, take heed to, Shaan's advice and kind of the breakdown of what we discussed today. Um, in 1 minute, if you can, what is some of the things that you've done, or how some of the things that you've done, experiences you had over your course of your life, your career,
Mm.
how did they have compounded to get you where you are today? I know.
Great question. No, you put me on the spot. No, I love it. I mentioned my background is engineering. It's operations, and I think good real estate comes down to good operations, and it was applying kind of those good practices, standardization, process, efficiencies into a subject matter and subject material that I really liked. And I found that within real estate and now within retail specifically. So my path was not just straight up and to the right. There was this and then back and then down and up and then down, right? All over the place. And so just continually learning, compounding. I've done engineering and operations. I have done residential. I've done multifamily. And now I do retail, and kind of taking the learnings from each of the thing I learned before and applying it to the next one has always been beneficial, right? Being able to operate a multifamily asset and understand the nitty gritty has made then understanding, retail and net lease and the different types of value add managing construction projects, improvements. They're different, but they're actually not that different. And you can apply a lot of those same learnings across, as we mentioned, the four different food groups. But specialization also helps. So I'm happy to be doing what I'm doing now and just digging deeper into the net lease retail space.
Well, brother, I appreciate you.
Of course.
That's all we have for the day. For everyone that's joined and listened, I appreciate you. Shaan, my guy, appreciate you for coming
Thank
on
you,
and
Brian.
shedding some light, some knowledge on what you do. And hopefully everyone hits you up and then things move forward. So
I
everyone,
welcome it.
have a great rest of your day. Shaan, peace, dude. Appreciate you.
Take care, Brian. Thank you.